Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. I hope that everyone's had a great week. It is September 12th of 2022, and we're certainly glad that you could join us today. And, one minor little housekeeping item that I want to address is that from this point going forward, and actually the last time we did the weekly update, we did this as well, is that we are going to be distributing our weekly updates on Mondays versus Fridays, just so that we can get you ready for the week ahead and not just discuss what's already happened. We kind of want to tackle both issues, both what happened and what we're expecting here in the next few days and the game plan for that. So without further ado, let's go ahead and get started. So the title of this week's presentation is Tiptoeing Through September. And the main reason that we're calling this week's presentation Tiptoeing Through September is that we have, over the last 2 to 3 weeks, reduced our net long positions in the portfolio. Now, for those of you with us, you'll know that January through really mid-May was a really painful time period. We had a very nice and robust short cover rally that lasted really since the beginning of June through to the end of August for the portfolios. But as we rallied, what we did here in the last little bit of August and into September is that we reduced our net long positions. Why? Because we were expecting volatility, as we discussed in the last 2 updates. We did expect volatility in the month of September and the first part of October. So we are taking proactive measures to reduce that volatility as we go through a period of what we expect to be heightened uncertainty. So this week's presentation, we're going to focus on 3 things. What is our net long exposure as we go through the month of September? How do we balance short-term risk with otherwise very attractive long-term opportunities? And then lastly, we're going to review some of those emerging leadership trends that are starting to take place underneath the overall hood of the market. Now, with the growth portfolio in particular, what we see here is we have about a 63% at-risk long position in the market. In other words, these are investment positions that are bets on rising prices in the overall market, right? So otherwise stocks. We have offset that risk through a 55% beta hedge. Now, what is a beta hedge? A beta hedge is a hedge that aligns with the overall volatility and risk of your long positions. In addition to that, we have an 18% volatility position. So in other words, as volatility rises, the portfolio benefits. As volatility falls, it actually detracts from performance. So overall, right now, we have about a 10% net short position going into the market. Now, is this a long-term net short position? No. We actually expect to roll these hedges off as we get into October and to really sort of unleash these emerging trends that we see underneath the portfolio. But as of right now, we're about 10% net short position. Now, it's worked out pretty well this week. Now, with the exception of Friday, where we're actually down a little bit this week, today in a up tape, mostly caused by garbage short covering and a lot of the worst of the worst names out there. We've been up every day this week in an otherwise sort of mixed tape. And we're happy with that. The longs are carrying a disproportionate weight relative to the hedges, and we've seen that translate into pretty decent performance. So in addition to how the portfolio is broken down, underneath the hood, those long positions, we're focused on a few areas: biotech, healthcare, alternative energy, and emerging consumer brands, or established consumer brands that are otherwise reaccelerating here in an otherwise uncertain tape. Now, what triggered some of our more cautious positioning here into the end of August? One thing in particular, but otherwise a few things, is that what we saw was, for the first time since the bear market rally started in June, is that the S&P 500 put in a new 20-day low. Now, from a technical perspective, when you get a 20-day low in a downward sloping 200-day moving average market where the market is trading underneath your 200-day moving average, that's what we call a reassertion of prior downward trends, right? So we had a downward trend from January through mid-May. We had a bear market rally. We rallied right underneath the 200-day moving average, and the market rolled over and established a new 20-day low. When that happens, it is typically, from a historical standpoint, prudent to act with a little bit more caution over the next 4 to 6 weeks, which is exactly what we're doing. The second thing is that we're in a seasonally weak period of the market. Whether you're a retail or institutional investor, most people respect the fact that September to October can be seasonally weak. Now, from an overall standpoint, the percent of observations that are positive versus negative is not crazy. I mean, you have 44% of observations that are positive, but historically, you have about a negative 0.5% rate of return. But here's the little caveat. When you're trading above the 200-day moving average, your historical September performance is about plus 0.2%. The overall historical September return is about negative 0.5%, which is not great. Most months are positive. But when you are under the 200-day moving average, the historical return for September is about minus 2.7%, with only about a 32% positive hit rate when it comes to the month of September. So being under the 200-day moving average, rolling over under the 200-day moving average, and establishing a new 20-day low for the S&P 500, and being in the month of September, again, we just want to be cautious as we go through here the month of September and the first part of October. The other big thing that has started this month is the balance sheet unwind accelerating by the Federal Reserve to the tune of $95 billion worth of bonds that are being sold by the Treasury. Now, here's why we are a little bit concerned about this. You're taking a lot of liquidity out of the market. So we're not necessarily concerned about recession. We're actually concerned about a liquidity trap in the overall market where you could enter a 4 or 5 day period where you just, you get your head chopped off. And so that's a lot of what we're worried about here, is this liquidity that's draining out of the system at a very rapid rate that's never been done before. And when something has no historical context, I always think it's better to be a little bit prudent, right? So we're up for the week, down a little bit today, and leaving a little bit on the table on Friday, but that's okay. The way I look at it is, for the 4 days that we traded this week, we were up 3, down on 1 day, and put up 1% of capital to otherwise reduce volatility quite a bit as we go through a period of uncertainty. I like that price. I think that's a good risk reward overall. And then right now, volatility remains pretty cheap relative to price. So when we look at where stocks are trading, when we look at where the S&P 500 is trading, and then when we look at where the VIX is, we actually think the VIX is pretty cheap here at these levels, trading around 23 to 24, putting in actually a big higher low. And we haven't really had a capitulatory sell-off yet. So, being able to hedge using volatility, I think, is a cheaper way to do it versus straight out just shorting stocks, which can be hard over the short period of time. So we like doing it through volatility and through some beta hedging, specifically within the technology sector. So all of that said, all of that short-term caution set aside, where do we see gathering evidence that of leadership for the next bull market, right? So when we think of the next bull market, we want to start the homework when we're going through that weak period in stocks. And so right now, a few things that we want to look at. Right, the average stock has a tendency to bottom ahead of the overall market. So in 2008, we saw copper stocks, we saw technology stocks, those types of stocks that started to bottom in November and December, while the overall market bottomed in March. That's an important point. The indexes tend to, from a historical standpoint, bottom last, while the average stock tends to bottom ahead of the overall index. Very important. Number two, leadership stocks historically make higher highs during a depressed market. So where are we looking at right now? If you look at solar stocks right now, if you look at biotech stocks, if you look at certain consumer stocks, and we don't own these yet, but we've been looking at companies like Chipotle or Starbucks or Lululemon, they've been breaking out to higher highs while the overall market has been selling off. These are the types of trends that we look at, or dislocations that we look at, when we're trying to figure out where we want to go long from an individual stock perspective, and of course, making sure the fundamentals align with our overall growth focus. And then lastly, it's important to note that the prior bull market leaders rarely lead the next bull market. So when we think of what were those leadership stocks in the last bull market, it's very rare that outside of leading on a short cover rally, it's very rare that they actually lead long-term for the next bull market. So right now, again, biotech, healthcare, alternative energy, and select areas within the consumer areas that we're focused on as potential leadership into the next bull market. We can see the chart here, solar stocks acting well in an otherwise awful tape. We see the same thing here with biotech. So we're using the XBI chart, that's the equal weight biotech ETF. Again, put a big low in the month of May, retested the low in June, and has been breaking out higher ever since. Again, from a relative standpoint, relative to the S&P 500 equal weight, also breaking out, offering clues of leadership there that we want to pay attention to. On the consumer side, it's much more of a stock pickers market. So Celsius Holdings, which is a stock that is held in the growth portfolio, that is one that is breaking out close to 52-week highs, again, within a bear market. So something that we want to pay attention to. We've seen similar setups with stocks like Starbucks or Chipotle, Lululemon. So again, stocks that we're starting to sharpen our pencils on. We don't own them yet, but something that we want to pay attention to within the consumer space as well. So the bottom line is we do expect volatility here over the short term, but now is the time we want to begin positioning for the next cycle. Over the next couple of days, we're going to get an inflation report. We're seeing a lot of short cover buying into that inflation report. I think everyone's on the side of we're going to see inflation come down because of gasoline prices, but it's that core number where we have a little bit of uncertainty right now because we did see some sticky labor numbers in August. Real estate has just started to roll over, but rents have continued to creep up. So a little bit of caution here, I think, is warranted. But underneath the hood of that pessimism, we are starting to see increasing signs of evidence that certain leaders are starting to pre-position themselves for the next bull market. And that's where our focus is right now. So overall, cautious short term, but long term, we are positioning for the next bull market. If you have any questions or concerns, please feel free to reach out to your advisor or to us directly at 888-543-3776. And again, have a fantastic week. Thank you.